Welcome back, everyone. Today, we're taking a deep dive into the world of value investing.
One of the most influential investing philosophies out there.
Absolutely. We're going to be unpacking Oguz Erkan's book, Value Investing Blueprint.
It's a fantastic resource.
It really is. It's packed with insights and practical advice, and we're going to try to distill those key takeaways for you today. So get ready.
It's all about making smarter investment decisions.
That's the goal. Now, one of the things that struck me early on in the book is how Erkan distinguishes between, well, what it really means to be a speculator versus a value investor.
Yeah, that's a fundamental difference.
He says speculators are targeting returns,
Right. Chasing those big gains.
while value investors,
They're targeting risk.
and that's a huge shift in perspective, right?
It is. It's all about focusing on what you can control as an investor.
So could you elaborate on that a little bit?
Yeah.
Why is targeting risk so crucial for a value investor?
Sure. I think the best way to think about it is like this. A speculator is like someone who's, betting on a horse race. Okay?
They're hoping for that quick win, that big payoff.
They're driven by that excitement, that potential for a big win.
Exactly. And there's nothing inherently wrong with that, but it's a very different approach from a value investor.
So how is it different?
A value investor is more like a farmer.
Okay, I like that analogy.
They're carefully cultivating their crops, understanding that consistent effort over time leads to the best results.
So it's a long-term game.
It is. It's about thinking long-term, building wealth steadily, and not getting caught up in the hype or the noise of the market.
That makes a lot of sense. It's about building a solid foundation, like you said, like a farmer cultivating their crops.
Right. You're not going to get rich overnight,
Yeah.
but you're going to be building wealth in a sustainable way.
Now, we can't talk about value investing without mentioning Benjamin Graham, often called the father of value investing.
He's the legend.
And he famously defines investing as an operation which, upon thorough analysis, promises safety of principal and an adequate return.
Such a powerful definition. It really is. It gets to the heart of what value investing is all about. So let's unpack that a bit. What does safety of principal mean in practical terms for the everyday investor?
It means your primary goal is to preserve your initial investment.
Okay.
So before you even think about returns, you're focused on protecting what you've already put in.
It's about minimizing losses.
Precisely. And once you've established that safety net, then you can start looking for a satisfactory return.
So it's not about hitting those home runs, those massive gains.
Not necessarily. It's more about consistent growth over time.
It's about building wealth slowly and steadily.
Exactly. Think of it like a snowball rolling down a hill. It starts small, but as it rolls, it gathers more snow, growing larger and larger over time.
I love that image. It's about momentum and the power of compounding. Now, Erkan uses a brilliant analogy to explain the concept of margin of safety, which he calls the core of value investing.
It's such a critical concept.
He compares buying a business to buying a cash-producing machine.
Right, like a vending machine or a laundromat.
Okay, I'm intrigued. Can you walk us through that analogy?
Imagine you're looking at a machine that reliably produces $100 every year.
Okay, $100 per year, consistently.
Would you be more inclined to buy it for $500 or $1,500?
Well, obviously, $500 sounds like a much better deal.
Exactly. That's margin of safety in action. You're buying that machine, or in this case, a business, for significantly less than its intrinsic worth.
So you're getting a bargain.
Essentially, yes. And that discount, that difference between what you pay and what it's actually worth, that's your margin of safety.
It's like a buffer.
Exactly. It helps protect you in case your initial calculations are a bit off or if something unexpected happens.
It's like having a cushion for those inevitable bumps in the road.
Yeah.
Erkan then outlines what he sees as the 4 key elements to successfully using this margin of safety strategy.
I'm listening.
First, you need to understand what undervaluation is.
Makes sense.
Then, why it happens.
Okay.
Next, how to identify it in the market.
Right. Finding those opportunities.
And then, he says, perhaps most importantly, you need to have the patience to wait for the market to correct itself. He argues that those 4 elements are key.
Patience is definitely a virtue in value investing.
It's hard, though, isn't it? We're constantly bombarded with information, news, and those tempting get-rich-quick schemes.
It's everywhere you look.
It's easy to get caught up in that frenzy, that fear of missing out. But value investing requires a different approach, doesn't it?
Absolutely. It requires discipline. It's about trusting your analysis even when the market seems to be disagreeing with you in the short term.
It's about blocking out the noise and focusing on the fundamentals.
Exactly. It's like resisting the urge to buy the latest trendy gadget and instead saving up for that timeless piece that will hold its value.
That's a great analogy.
Yeah.
Now, before we all rush out to buy any stock that looks cheap, we need to talk about value traps.
Ah, yes, those are dangerous.
These are stocks that might appear to be bargains on the surface, but could actually lead to significant losses if you're not careful.
They can be very deceptive.
So what are some of the key red flags that we as investors should be aware of? How can we avoid falling into these traps?
Well, the first thing to remember is it's not enough to just find a stock with a low price.
Right, a low price doesn't always mean it's a good value.
You need to understand why it's priced that way. Is it a fundamentally sound business that's facing some temporary headwinds, or are there deeper issues that could signal a long-term decline? Erkin describes 4 main types of value traps to watch out for. We'll start with the low multiple value trap. This is where a company might have a low price to earnings ratio or low price to book value, but it's not actually a good deal.
It's misleading.
It can be.
And he uses the example of Rag Shops, Inc., a now defunct fabric and craft supplies company, to illustrate this point.
Right. They had a low price to book multiple, making them look attractive to some investors. But a closer look revealed consistent profitability issues, a reluctance to engage with investors, and intense competition in their industry. So those red flags were there if you dug a little deeper.
This highlights why it's so important to look beyond those surface-level numbers and really understand the underlying business, its challenges, and its potential.
Exactly. Sometimes there's a good reason why a stock is cheap, and it's not always a good thing.
Okay, so we've got to be cautious. What's the next trap on our list?
The next one is the lack of catalyst value trap. Think of a catalyst as the event that sparks a stock's price movement.
The thing that gets it moving.
Right. It could be a new product launch, a change in regulation, a merger or acquisition, something that fundamentally changes the company's prospects. Without a catalyst, even an undervalued stock might just sit there.
Stuck in neutral.
Exactly. And Erkin emphasizes that for value investors, the most dependable catalyst is earnings.
Consistent earnings growth.
Yes, consistently strong earnings usually signal a healthy business, which in turn tends to attract investor interest and drive up the share price.
That makes sense. Earnings are like the fuel that propels a company's growth.
And ultimately, it's stock price.
Okay, earnings are key. What's the third type of value trap we should be aware of?
This one is the multiple kinds of shares trap. This can get a little technical.
I'm ready.
It essentially boils down to this. Different classes of shares can have different voting rights, dividend payouts, and even priorities within the company structure.
Different levels of ownership.
Right. And Erkin cautions that companies with dual classes of stock, for example, might prioritize certain shareholders, often insiders, or large investors, over common stockholders.
So it's not just about the price of the stock, but also about the rights and privileges that come with it. You really need to understand the structure of a company's share classes and how they might impact your investment.
Absolutely. And then the final trap, which might seem counterintuitive at first, is the tightly held company value trap.
Okay, this one sounds interesting.
Usually we think of high insider ownership as a positive sign. Right?
Yeah, it shows they believe in the company.
It can be a good sign, but the potential downside is that a high concentration of insider ownership might deter institutional investors like mutual funds and hedge funds.
Oh, I see.
These investors bring in capital, liquidity, and often have an influence on corporate governance. So without them, a stock might struggle to gain traction in the broader market.
Even if the underlying business is strong.
Exactly. It's a delicate balance. You want to see some insider ownership as a vote of confidence, but too much concentration could hinder broader market interest and potentially limit the stock's growth.
It's a lot to consider.
It is. Value investing isn't a passive activity.
You really have to do your homework.
You do, but that's part of the appeal, isn't it? It's about understanding businesses, assessing risks, and making informed decisions.
It's about being an active participant in your financial future.
Exactly.
And with that, I think we've laid a solid foundation for our deep dive. We've covered the basics, the definition of value investing, the importance of margin of safety, and the potential pitfalls to avoid.
We've got our toolkit ready.
And in the next segment, we'll delve deeper into the nuts and bolts of fundamental analysis and valuation.
The real detective work begins.
Get ready to put on your thinking caps, everyone. Earlier, we talked about how value investors are really looking for conservatively financed businesses.
Right. Ones that can weather those economic storms.
Exactly. It's not just about finding a company that's profitable today. It's about finding those businesses that can navigate those ups and downs, those inevitable challenges, and still come out stronger on the other side.
It's like building a house on a solid foundation.
Perfect analogy.
Yeah.
You want that foundation to be strong enough to withstand whatever comes its way. So how do we, as investors, actually assess a company's financial strength? What are those key indicators?
Well, Erkin emphasizes two main areas you want to focus on: earning power and financial strength.
Okay, let's break those down.
Let's start with earning power.
Sounds good.
Because ultimately, a business's value is driven by its ability to generate consistent earnings.
Right, it's about those profits.
It is. But we're not just looking for those companies that have a one-time earnings spike.
Okay.
We want to see stable, predictable growth over time.
Makes sense. Steady and reliable.
Exactly. And actually, he compares two hypothetical companies to illustrate this point.
Oh, I remember this.
Company A has steady, incremental earnings growth year after year.
Okay, slow and steady wins the race.
And then there's Company B, which has some impressive jumps in earnings,
Sounds promising.
but also some dips.
So it's more of a roller coaster.
It is a bit more volatile.
Okay, and what's the takeaway there?
Even though Company B might have higher total earnings over a given period, Company A is actually the more attractive investment from a value perspective.
Interesting. Why is that?
Because that stability and predictability are key. They reduce your risk as an investor, and they allow you to forecast those future earnings with more confidence.
So you're not getting those wild swings and surprises.
Exactly. It's like choosing between, say, a reliable friend who's always there for you and a flaky friend who's hot and cold.
I see your point.
Value investing is about finding those dependable, steady businesses that can deliver those consistent results over time.
Got it. So we've covered earning power.
Yeah.
What about financial strength? What are some of those telltale signs of a company that's, built to last?
That's where we look at those key financial ratios.
The numbers.
And the numbers. They give us a glimpse into a company's overall financial health.
Okay, let's dive in. What's the first ratio we should be looking at?
The debt-equity ratio?
Debt, that word always makes me nervous.
I know, right? But it's an important one to understand.
So break it down for me. What does this ratio tell us, and what would be considered a healthy level?
The debt-equity ratio shows us the proportion of a company's financing that comes from debt compared to equity.
Okay.
A lower ratio is generally better.
Less debt.
Exactly. Ideally, you want a debt-equity ratio of less than 1,
Okay.
which means the company has more assets than liabilities.
So they're not over-leveraged.
Exactly. It indicates that they're not overly reliant on borrowed money to operate their business.
Makes sense. What's next?
The next ratio to look at is the current assets, current liabilities ratio, sometimes called the current ratio.
Okay.
This one tells us how easily a company can cover its short-term debts with its short-term assets.
So its ability to pay its bills.
Yes, it's a measure of their short-term liquidity.
How much cash they have on hand.
Right. A healthy current assets, current liabilities ratio is generally between 1.2 and 2.
Okay.
This means they have enough liquid assets to meet their short-term obligations comfortably.
So they're not scrambling to make those payments.
Exactly.
What about the debit ratio?
Right, so the debt-bit ratio, EBIT stands for earnings before interest and taxes.
Okay.
And this ratio tells us how many years of earnings it would take for a company to pay off all of its debt.
So the shorter the time frame, the better.
Generally, yes. A well-managed company should be able to pay off its debt within a reasonable time frame, say 3 to 4 years of earnings.
Okay, that seems manageable.
A debt-bit ratio of less than 4 would typically be considered prudent.
Got it. And the last ratio on our list.
The final one is the EBIT interest expense ratio.
Okay.
This one focuses on the company's ability to cover those interest payments on its debt.
Makes sense.
You definitely don't want to see a company that's struggling to make those interest payments because that's a sign of potential financial distress.
So a higher ratio here is a good thing.
Yes, a higher ratio means their earnings can comfortably cover their interest expenses, even if those earnings fluctuate a bit.
They've got some wiggle room.
Exactly. A ratio of 1.5 or higher is generally considered a safe zone.
Okay, so we've got these 4 key ratios to watch. But I imagine some people listening might be feeling a bit overwhelmed by all these numbers.
It can seem a bit daunting, yeah.
It's a lot to digest. So how can the average investor use this information in a practical way?
Well, Erkin provides a really helpful value investor checklist.
Oh yeah, I remember this.
Think of it as a set of guidelines, not rigid rules, but those important factors to consider when you're evaluating a potential investment.
So let's walk through this checklist. What's the first item?
The first item he mentions is adequate size of enterprise.
Okay, what does that mean?
He suggests looking at companies with a market capitalization of at least $1 billion.
Okay, so larger, more established companies.
The reasoning there is that larger companies tend to be more established.
Right.
They have more resources,
Mm.
and they often experience less volatility than small companies,
So they're a bit more stable.
which aligns with that whole value investing philosophy.
Makes sense. What's next on the checklist?
Next on the checklist is earnings stability.
Okay, tell me more about that.
He specifically advises seeking out companies that have had no losses in the past 10 years.
Wow, 10 years. That's a long time.
It is. It shows they've been able to maintain profitability even during tough economic times.
So they've proven themselves.
Exactly.
Okay, what else?
Then he talks about revenue growth, recommending around 10% annually for the past 5 years.
So we're looking for growth, but it doesn't have to be explosive.
Right. Steady and sustainable is the goal.
Makes sense.
It's about finding that sweet spot of healthy growth without taking on excessive risk.
And then, of course, we have our 4 key financial ratios, which we just discussed.
Right. The debt-equity ratio,
Below 1.5,
the current assets, current liabilities ratio,
above 1.2,
the debt-bit ratio,
smaller than 4.
and the EBIT interest expense ratio, at least 1.5.
Got it. So this checklist seems like a really practical tool for anyone who's looking to apply a value-oriented approach.
I think so. It helps to streamline the analysis process and ensure you're focusing on those most crucial factors.
But it's important to remember it's not a magic formula.
Right. This is just a starting point, not a finish line.
You still need to do your own research.
Yes. Dive deep into understanding the business.
Yeah.
Consider all those factors that might influence its future performance.
It's about seeing the whole picture.
Exactly.
Speaking of which, let's move on to the topic of business valuation. Because knowing how to assess a company's worth is critical for any value investor.
Absolutely. You need to know what you're buying.
It's like being able to tell if you're getting a good deal on a house or a car.
Yeah.
You don't want to overpay.
Right. And here's where things get really interesting, because Erkin emphasizes that business valuation isn't just about crunching numbers.
There's more to it than that.
There is. It's also about crafting a narrative, a story about the company's future.
So it's like being a detective, but also a storyteller.
Exactly. You're piecing together clues from those financial statements,
Right.
but you're also envisioning how the company's story might unfold in the years to come.
Okay, I like that. It's about using your imagination, too.
It is, and that's why he refers to valuation as an art.
An art.
There's that quantitative side, of course,
The numbers.
but there's also that qualitative aspect,
Yeah.
that interpretation, that narrative building. That's what separates a good valuation from a truly insightful one.
So how do we blend this art and science of valuation? Where do we even begin?
Well, Erkin highlights another key concept. Valuation is a range.
Okay, I'm listening.
Instead of aiming for a single precise number,
Okay.
he encourages us to think in terms of a range of potential values
Based on?
based on different scenarios, different possibilities.
Right, because the future is inherently uncertain.
It is. So we're not trying to predict the future with absolute certainty.
Okay.
We're acknowledging that there's a range of possibilities.
Makes sense.
And to help us through this valuation process, he introduces us to Benjamin Graham's simplified formula for valuing growth stocks.
Benjamin Graham. Back to the legend.
He's the OG of value investing.
Okay, so what does this formula entail?
It's a method for estimating a company's intrinsic value using its earnings, expected growth rate, and prevailing interest rates.
Okay.
He even walks us through a real-world example using Coca-Cola to show how the formula works in practice.
Coca-Cola, classic example of a value stock.
It is. So he takes their trailing 12-month earnings per share, their long-term expected growth rate, and the current yield on AAA corporate bonds.
Okay.
And he plugs those figures into Graham's formula, and he arrives at an estimated intrinsic value for the company.
And how did that estimated value compare to Coca-Cola's actual trading price at the time?
In this case, the calculation suggested that Coca-Cola might be slightly overvalued,
Oh, interesting.
based purely on the numbers.
Right.
But this is crucial. He stresses that this is just a starting point.
Not the end of the story.
Not at all. Remember, we're not just looking at numbers in isolation here.
We're trying to understand the whole picture. Right.
Right. The qualitative factors, the competitive landscape, the strength of their management team, the brand's enduring power, All those things you can't capture in a simple formula.
Right. It's about looking beyond the numbers.
Exactly. And that's where the art of valuation comes in.
The art.
The ability to synthesize those numbers with a compelling narrative about the company.
To really make sense of the data and to adjust that valuation based on your own insights and analysis.
Right. To bring in your own judgment and expertise.
Okay, so we have our initial valuation using Graham's formula as a foundation. We've added our qualitative assessments, considered those different scenarios, and we've arrived at a range of potential values for the company. Now what? How do we make that critical decision to invest or not?
Well, this is where our old friend, margin of safety, steps back into the spotlight.
I was wondering when we'd get back to that.
Because even after all that meticulous analysis, even after crafting that compelling narrative,
There's still room for...
there's always a chance that we've overlooked something,
Right.
that our assumptions were a bit off,
Okay.
or that some unexpected events might occur that we didn't anticipate.
The market can be unpredictable.
It can. So margin of safety acts as our buffer. It protects us from those unforeseen twists and turns.
It's like having that extra padding when you're learning to ride a bike.
Exactly. You might fall, but it helps to cushion the impact. Erkin suggests a margin of safety between 10% and 35%.
Okay, that's a pretty wide range.
It is. And it depends on your risk tolerance as an investor
Yep.
and how confident you are in your analysis.
So the more confident you are, the smaller the margin of safety you might need.
Exactly. So even if your valuation suggests that a company is worth, say, $100 a share,
You might only be willing to.
you might only be willing to buy it for $70 a share to factor in that potential for error or those unexpected events.
That's smart. It's about being conservative.
It is. And he strongly cautions against compromising on that margin of safety.
Right, because it can be tempting.
It can be so tempting to jump in when you see a stock that looks like a bargain.
Right, you want to grab it before.
But without that buffer, without that margin of safety,
You're exposed.
even a small miscalculation can lead to losses.
So it's about being patient
Yes.
and having that margin of safety.
Those are the guiding principles for a true value investor.
It's not about chasing the next hot stock or trying to time the market perfectly. It's about uncovering those undervalued gems that others might be missing.
And having the conviction to stick with your analysis even when the market doesn't immediately agree with you.
It's about thinking long-term, not short-term.
Exactly. It's a philosophy, a way of thinking.
And that's what makes it so compelling, isn't it? It's not just about making money. It's about developing a sound framework for thinking about businesses, assessing risks, and making those smart investment decisions. Decisions that can build wealth
Steadily and
sustainably over time.
That's the goal.
I feel like we've been given like a treasure map,
Yeah.
and now we have all the tools we need to go out and actually find those hidden gems in the market.
That's a great way to put it.
We've covered so much ground today. I mean, we've explored the core principles of value investing, from understanding the difference between speculation and investing to mastering the art of fundamental analysis, all the way to like valuation.
Yeah. And the importance of margin of safety.
That's right. That crucial buffer that helps protect us from all the unknowns that are out there in the market.
Yeah, it's impossible to predict everything.
Right. And we even take a deep dive into how to identify those tricky value traps, those stocks that might look like a good deal, but actually could lead to, significant losses.
Yeah, those can be sneaky.
They really can. And I don't know about you, but I feel a lot more confident in my understanding of value investing now.
I think that's the goal of these deep dives, to give you the knowledge and the confidence to approach the market in a more informed way.
It's all about empowering ourselves, isn't it?
Yeah.
To make those better decisions, those smarter decisions with our money.
To think like an owner, not just a trader.
Exactly.
Yeah.
But, this is just the beginning, right?
It is. It is. The real learning starts when you take these principles and you actually apply them to your own research.
That's the exciting part, right? Actually going out there and putting everything we've learned into practice. It's kind of like learning a new language. You can study the grammar, you can memorize the vocabulary, but you don't really become fluent until you immerse yourself in the language.
Right. You got to get out there and start speaking.
Yeah, you got to use it.
Yeah.
So now that we've got this foundation, this framework, what industry or company are you itching to analyze?
I know. I've got a few ideas swirling around already.
What sparks your curiosity?
Yeah.
What companies or sectors really align with your interests and your values?
That's the real challenge, isn't it? Finding those companies that you really connect with.
Absolutely. So that's the challenge we leave you with today. Go out there, explore, and remember, the journey of a value investor is one of, well, it's one of continuous learning
And discovery.
and discovery, and hopefully, profitable returns.
Happy investing, everyone.
Happy investing and happy deep diving. We'll be back soon with another deep dive into a new topic and a fresh set of sources.
Always more to learn.
Until then, keep learning, keep exploring, and keep those brains engaged.
See you on the next deep dive.
Bye, everyone.